YouTubers, Mike Martins here, Mike Martins channel. Man, this is a humongous deal, guys. Canadians owe over $294 billion secured against their home equity. Holy smokes. Home equity. This is a lot of cake, guys. This is a lot of money. And you don't need me to make a video to tell you that. But things are really getting out of control. And we need to create some sort of an awareness. Guys, I'm getting bombarded with a lot of message about the Opal Towers in Sydney. I'll leave a link at the end of this video where you can see the Opal Towers, where it's a new tower being built, and it's only 4 months after people moved in. It's starting to have fractural problems, and some of the plasters breaking, and the building slightly shifted, and they're evacuating the building. So we got Peter on the ground, Peter in Sydney, who's going to go on the ground and do some of his own investigative research here for the Mike Martins channel to find out what's going on there, kind of do his own poking around there. The site is only 20 clicks from his house, so he's going to go check it out for us, and we'll do Mike in the Night, and we'll get people to call in from that area, because it's actually a big deal, and this could be coming to a city near you. But let's get to the problem at hand here. Canadians owe $294 billion secured against their home equity. Canadian real estate owners borrowed another billion against their home equity. Officer, Superintendent, Financial Institution. Numbers show that the balance of loans secured by home equity hitting new record in October. The balance, which is slowing in growth, is primarily consumers borrowing for personal consumption. So people are eating, guys. Loans secured by residential property. Loans secured by residential real estate are when borrower pledges a home as collateral for a loan. Securing the debts with real estate allows borrowers to get both cheaper and larger loans. The most popular form of debt issued this way is by home equity line of credit, HELOC, or a second mortgage. Regulators like to split the category into two segments of personal business. So you got a loan to value, you got a value in your house, and you got a ceiling, a debt ceiling. So if someone goes out and appraises the house and say, yeah, this house is worth $600,000, and let's say you owe $200 on it, so they'll give you $350 line of credits, a $350,000 line of credits. They'll back off a bit just in case there's any movement in the market. But now appraisers are coming back even cheaper just to cover their butts and to cover the banks, right? Personal and business loans secured by home equity are done the same way, but meant different things. Personal loans are generally for consumption, meaning that cash is mostly gone. Banks pitch consumers on loans for vacations or suggesting using a down payment on a second home. Business loans are routine, since new companies often need a personal asset guarantee. Seeing growth within personal loans means people need short-term cash flow assistance to consume. That's generally a bad thing. Seeing a rise in business loans means businesses are confident in expanding, which is a good sign. We want to see low growth in personal and high growth in business, ideally. So I brought this up last time in the last video saying, guys, we need more business loans. We need more people being hired. We need more private sector jobs, not this public sector crap. Total debt secured by home equity rises over to $294 billion. The total debt secured by residential real estate hitting new record. The outstanding balance of these loans reached $2.16 billion in October, up 0.63% from the month before. This is increased by 4.5% when compared to the same month last year. We're still seeing sustainable growth, but it's a lot slower than last year. So look at this. Total of total and business loans secured with residential real estate. Holy smokes, guys. That's a lot of cake, man. The total growth rate is still high, but lower than last year. Last year, this time, we saw a 12-month pace of growth, 9.03% in October. That puts the growth rate at 50% lower than the same month last year. Personal loans secured by home equity rise to over $264 billion. The vast majority of loans secured by home equity are for non-business purposes. The outstanding balance is the segment reached $264.76 billion in October, up 0.55% from the month before. That's an increase of 6.12% when compared to the same month last year. Holy crap! That's huge! Personal loans in this segment have hit a new record, but the pace of growth is starting to taper. Personal loans secured with residential real estate. There it is there, guys. Holy crap. Personal loans. Your HELOCs October growth is down from the same time last year and following a trend of slower growth. The 6.12% 12-month change in October is slightly lower than the month before, also 2.08% lower than the month last year. That said, the rise in the cost of servicing these loans should have reduced the pace of growth more. Yeah, with interest rates going up, yep. The balance of business loans secured by home equity is falling. The total outstanding balance fell 29.402 billion, up 1.39% from a month before. So it's still going up monthly, guys. The outstanding balance is down 8.12% compared to the same month last year. Unfortunately, the segment that we want to see growth in is falling the fastest. Business loans secured. This is the most important part right here, guys. It's business loans secured by real estate, because business is what is the middle class. That middle class, that working middle class, is what keeps the rich, and it keeps our hospitals open and keeps basically funds our public sector jobs that come around and tell you to shovel your snow, or come around and give you a hard time. You know what I'm saying? The pace of growth is way slower than we observed last year. In October 2017, we saw a 12-month growth rate for businesses. Loans hit 36.88%, which is a monster growth. This year, we're 122% lower than that number and actually seeing a contraction. It's great business. Businesses are paying off the loans. It's also concerned that other businesses don't see this as a time to borrow. The decline in growth is expected as interest rates rise. After all, higher borrowing rates are designed to slow credit growth. The growth rate for HELOC is still far outpacing the credit growth, though. That's huge. So people are borrowing more than what's being paid down. People are paying to consume. People have left the big cities. A lot of the big cities have turned into empty shells, artificially inflated by housing bubbles, record low interest rates, government intervention that's been a failure. Thank you, Better Dwelling, for bringing this up. I really, it's good that you guys are on your toes when it comes to this. And maybe do an article about me one day. I've been read so many of your articles for years now. And maybe they could write, local Vancouver guy leaves the city and blah, 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 and starts what he can out in a small town type of thing, and didn't believe in it, but making videos for, man, it's going on to 8. My first channel got deleted. Then I reopened my channel because I was really on the housing thing, really talking and pointing out houses on the street. And they didn't like when I went to go out and videotape houses for sale. That's public knowledge. But anyways, my oldest video I think goes back 4 years on this channel for real estate. But people know my older channel. Like, a lot of people could attest that I've been doing this. It's going to be 9 years this summer. Thanks for watching, guys. Let me know what you think in the link below, in the comments below. What's up, buddy?